Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and or financial topics. So I'll interject my opinions as we go. Let's dive in and see what people are sharing. If you want to follow me, it's at @Finance. If you want to join our community, finding-value.com. where I dive deeper into these topics and looking for potential commodity investments for this bull market that we are in. We still have coupon code Mayday that is active. So Logan, he looks into the housing data quite heavily. He says, prices have been a tad bit more stubborn than I thought this year, considering where rates have been. So his forecast, produced by himself for the Housing Wire, he's the lead analyst, predicts U.S. home prices will rise by 2.33% in 2024, with that range of about 1.9 to 2.8%. According to him, the outcome will depend on the direction of the 10-year Treasury yield throughout the year. He anticipates that inflation will outpace home price growth, resulting in a decline in inflation-adjusted home prices on a real basis, is what his guess will be or is. We've got Jim Rogers here, and I've used to listen to a lot of his interviews and would follow him on YouTube since the mid-2000s. What he's saying is, and I hardly ever hear them say this, he says silver is a good investment right now. I don't really hear that too much. He always says, for the most part, that things will get cheaper. He's waiting. He's got cash. It's very rare that he actually says that something's a good investment right now, which is very, very rare. So he said that. Mike Simonson, this is more on the real estate market. He says there are now 653,000 single-family houses unsold on the market. That's up 1% for the week, 40% more than last year. Inventory's up in every state, but some of the state-level trends are shifting. New York and the Northeast are finally growing out of the pandemic shortage. Some of the Florida markets seem to have plateaued in inventory growth. I included the decade view of available inventory today so you can see the absolute levels and the current growth trajectory. So here's current inventory level at 653,000. Back in 16, 17, 18, 19, which were still home price growth years, that was up towards 1 million. So we're still below that million, but we are definitely seeing inventory additions, which is, it's not necessarily bearish home prices, but it could be if these levels continue to go up and get up into the 1.5 million plus range for inventory, basically over double from where we are at today. Coming on back, we've got Martin. He says this did not happen when we went from horses to cars. It says a recent consumer study conducted by McKinsey found that 46% of U.S. EV owners who were surveyed said they were likely to switch back to gas-powered vehicles, compared to a global average of 29% of EV owners who said they would likely switch back to an internal combustion engine. So what he's saying is this isn't normal. It's almost like the electric vehicle world was forced upon the consumers, and the consumers are saying, I don't really want this electric vehicle. I'd rather have a combustion engine car. And maybe the EVs are just not advanced enough. Maybe there isn't enough charging stations. Maybe they don't charge fast enough. Whatever the reasons are, maybe they could get better with time. As hedge funds dump everything else, they buy energy and material stocks at the fastest pace in 5 months. And I know some people feel comfortable with, if they're buying energy, they want to see other people buy energy. But that's what hedge funds are doing. They're dumping everything except they are running to energy and material stocks. Now, in the cycle, the business cycle, energy and material do very well kind of later stage in the business cycle. Is that where we're at? Are we still in the mid-cycle wobble where interest rates go up, things slow down, and then they lower interest rates and everything ramps like no other with a weaker dollar? I tend to think that we're getting a slowdown in the mid-cycle wobble. That's kind of where I think we are. Difficult to say that with 100% certainty. Other people think that we are further along. I don't see the winner's curse phase in real estate occurring with where interest rates are at and the affordability. So it makes me think that things will have to slow down first. We'll have to lower interest rates, and then the homes will be built and we go into a hyper supply phase. We're not in a hyper supply phase because we don't have the inventory. So that's what makes me think we're in the mid-cycle wobble and where energy and materials could still go higher. And I think that's maybe perhaps what they think as well. Maybe. HFI research says over the weekend, lower 48 gas production averaged 102.3. So we're up. We've increased quite a bit from the lower production levels of April and May. And that has followed the price of natural gas higher, production has. So again, we'll see where it goes. We'll continue to monitor inventory levels, which I think I have down a little bit lower on here for nat gas. Coming on down, here is the U.S. horizontal rig count. It's down 8% year to date. You can see that we kind of peaked out in 2022, 2023. We rolled over from 700, and we are somewhere between 500 and 550. Pretty big decline from our highs back in 22, 23. Warren Buffett says, do not take yearly results too seriously. Instead, focus on 4 or 5 year averages. So don't try to play the short term is basically what he is trying to say. But definitely not quarterly results. He says yearly results are even too short in time frame. Focus on the 4 and 5 year averages where that is where your returns should be. If you're taking on enough risk and you've got entry points, sometimes it takes a little bit longer than a year to play out, I think is what he means by this. How concentrated has this market become? So just 17% of the S&P 500 stocks have outperformed the index over the last 30 days, the lowest share in at least a decade. In other words, only 85 stocks in the S&P 500 have had higher returns than the index itself over the last month. And generally, when breadth goes down like this, that is generally a precursor to a slowdown in the market. That's why we look at these things here. Big bull markets is where you get a larger percent that is higher. U.S. power demand is going from strong to very strong. This year was supposed to be a tough camp for gas burn. That's natural gas burn for electricity. As last year was quite hot, and this year had a lot of renewable capacity coming on stream. Instead, we are averaging greater than 1 billion cubic foot per day in power adds through May and June, and weather looks very supportive for July and August as well. To put that into perspective, if we can grind a 1 billion cubic feet per day of burns, adds, on average annually, that's the equivalent of an extra LNG export plant being added every 2 years that nobody was counting on even 6 months ago. 3 to 4% annual domestic and export growth moving towards 4 to 5% growth. 5% growth, 5 billion cubic feet per day per year, is a lot to ask of aging basins to do repeatedly. And so price comes up to incentivize more supply and switch out some demand where available back to coal. So this is your U.S. lower 48 generation year over year change. And you can see the big change here moving on up for trailing 12-month gigawatt hours for natural gas. Natural gas is in the square there that we've got. And then going forward, this is natural gas demand growth year over year in billion cubic feet per day. growth. In some of these areas, Rescom looks like it's a little bit down, but a lot of it's growing here going forward. We also expect a lot of strong liquefied natural gas demand going forward in America for exportable capacity to be increased quite substantially. Rob Keene says, almost on cue with my post here last week, gold and silver are fading back a bit as we work our way deeper into summer. My question for you is, who is doing the fading? Is it the general market seasonality sentiment, JP Morgan as some claim, or the plunge protection team? Well, what I heard is they'll let gold and silver go up, but they don't want it to be in an uncontrolled fashion. We just recently had a breakout, and this to me does smell of some weird thing where they're just dumping all in a very short time frame to get the price down, to try to slow down that price movement and sentiment. Kobayashi letter said, U.S. financial conditions are now the easiest in 27 years. They're even easier than when the Fed started raising interest rates in March of 2022. Since then, the Fed has hiked rates by 5.5% and shrunk its balance sheet by 1.7 trillion. Meanwhile, the U.S. economy has begun to slow, which shifted market rate cut expectations to the September meeting. Markets are trading like the Fed already have cut rates, and we're way up there towards the loosest market conditions in 27 years. That still seems a little bit crazy to me when I saw this. Bullish Trend says, while dumb money's buying tech stocks, smart money is buying energy stocks. Great one with Jesse Felder. And if you guys want to listen to this, you can see the gamma squeeze driving NVIDIA and Apple, and I guess his opinion, smart money running into energy. Silver's looking especially shiny in China today at 34.77 in the futures pricing. So we still have a large disparity between pricing of silver in China versus the pricing in the United States. And again, the metal will continue to move from west to east. Joseph Brown, this is accidentally just making the argument for a higher minimum wage. Also, with true sound money, wages go down nominally over time. So in 1964, the minimum wage was 5 90% silver quarters. In 2024, 5 90% silver quarters have a melt value of $28.34. We don't need minimum wages. We need sound money. And I agree with that. We need sound money. Without passion, you don't have energy. And without energy, you have nothing, says Warren Buffett. The earlier you find your passion, the better, because it won't seem like a chore to follow your dream. And you'll outwork everyone in the process, said Todd Combs. So I guess what you need here is you need passion in whatever you do so you can continue to do it. Grady here, it says the inflationary 1970s caused a massive rise in gold. When called the commodities bear market low back in April of 2020, he also thought that we were in for big inflation. I think it is time for the next historical inflationary wave, just like the 1970s. Yes, this is clearly a wild chart, but unfortunately, quite likely. Gold is now squeezed in between the blue lines below and has to make a choice to break upwards or break downwards. We know what it will be. It's going to be a move higher. It says this commodities bull market is the end of rainbow opportunity. So for heaven's sakes, do not mess things up, but make the most of it. So here is that gold chart. Zoomed in on it. It says the largest very probable bullish rising wedge continuation halfway pattern I've ever seen. We have the inflationary 70s, the first bull phase. The second bull phase is in the middle here. And then the third one, in his opinion, is coming. And he calls it the inflationary 2020s, the third bull phase. He says this wild chart does say that the target is $48,000, which would be the approximate number if the USD M2 was back 100%. As we go up, the volume drop on the back test is perfectly normal. So he is very bullish on gold. I would be too, and also on silver. We've got another one here too, and I wanted to cover this. He says this is what real hyperinflation does to a stock market. Early in the move, stock market's moves outweigh inflation. Later in the move, stock market gains are nowhere near the rate of inflation. Many will be fooled by Western stock markets going up hugely when the time comes. it is imperative to understand how things actually work. Then also add resulting depression, plus CBDCs, bail-ins, coming capital controls, bank closures, severe ownership issues, how long physical will be available, etc., etc. And it quickly gets complicated. It is vital to piece the puzzle together in order to understand what is coming, and in order to be prepared in detail in every way needed. So the Argentina stock market, 10,000% in 6 years, that's what hyperinflation looks like. People trying to short this market, good luck, because maybe we are going towards something that has very high inflation rates. I think that's what Grady's idea is about what is potentially coming in front of us. And I've positioned myself for an outcome that might be similar to this. So Tavi says, it amazes me that people overlook the fact that when adjusted for gold prices, the U.S. equity market has been historically overvalued as it was in the 1929 peak levels for some time now and regard this as a new normal. Investors' overall concept of risk has been largely abandoned. Perhaps that could be justified when interest rates are near zero, propping valuations to an extreme, but we no longer live in such an environment. Note that this metric peaked a few years ago. A downward trend is now becoming increasingly apparent. And we are back to historically overvalued levels for Dow Jones, very similar to the 1929 peak, very similar to the Nifty 50 bubble, and slightly below the tech bubble that occurred in 2000. He thinks that we're likely going to head lower in this valuation, and gold is going to outperform the Dow Jones Industrial Average. I agree with that evaluation as well. I think gold's going to outperform a lot of things. A lot of people say, they buy gold for insurance. I buy gold for the outperformance it's going to have in inflationary environments. So that's what I think is coming. And then the last quote here that we've got is money wisdom. People who live far below their means enjoy a freedom that people busy upgrading their lifestyles can't fathom. And that's the camp that I'm in. I enjoy a freedom that maybe other people don't enjoy. But that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. We'll catch you next time. This is Finding Value.